Good morning, this is your DealBook briefing for Saturday, August 1st, 2026. I'm Andrew Ross Sorkin. Today we're tackling the big questions hanging over the final frontier: who actually owns space, and how do the politics of the heavens work? Our contributor Peter Coy takes us inside a fierce, quiet battle over radio spectrum, international treaties, and the invisible real estate that could define the next century of commerce. Then, Bernhard Warner brings us a story from Siena, Italy, where the world's oldest bank is fighting for its life against a hostile takeover bid that has all the drama of a Renaissance power struggle. We'll also catch you up on a turbulent week in big tech earnings, a high-flying AI hedge fund's dramatic rescue, FIFA's abandoned equity sale, and a quiz about polling consumers who don't actually exist. Let's begin. The headline story this morning is what Peter Coy calls a space grab. Elon Musk's SpaceX is racing to acquire invisible real estate, the radio spectrum that carries wireless signals. Its competitors are doing the same, setting off a scramble that resembles the land rushes of the 19th century, except the territory is the air. The core tension is that radio spectrum cannot be legally owned. But as it has become vastly more valuable, companies and governments have been jostling to control more of it. On Earth, competitors have heavily invested in staking out rights to use broader swaths of airwaves. In space, China and other countries have signaled they want more say over who uses which spectrum to communicate with Earth. In the United States, the Federal Communications Commission has created a system where licenses to use specific spectrum bands serve as pseudo-property rights. The FCC allows them to be bought, sold, and leased with its approval, and renews them almost automatically, absent misconduct. The industry trade group US Telecom told a federal court that the industry sank more than $230 billion into FCC auctions, plus $700 billion into networks, on the assumption it was buying something close to property. That assumption is now being tested. Shares of phone and cable companies have been under pressure in recent months over fears that SpaceX will scoop up more spectrum at an auction next year and use it to compete with them directly, including by connecting ordinary cell phones straight to satellites. There's a parallel race for spectrum used to communicate with outer space, where satellite frequencies are managed by the International Telecommunication Union, a UN body. The U.S. government applies for these licenses on behalf of American companies under a first-come, first-served system. Later entrants can use the same airwaves but must coordinate with the incumbent to avoid interference. That system has worked exceptionally well for SpaceX and other American operators that filed early and in bulk. Much of the rest of the world isn't thrilled with this status quo. They see the airwaves less as property and more as a resource to be shared by all under international oversight. That may sound high-minded, but it's also a defensive move against powerful first movers like SpaceX. American negotiators are gearing up for a fight at the World Radio Communication Conference in October and November 2027 in Shanghai, home turf of a powerful Chinese delegation. Late-coming Chinese companies have flooded the ITU with applications for satellite frequencies while insisting on equitable access to bands where earlier filings, mostly by American operators, already hold priority. SpaceX itself pinpointed this geopolitical risk in the prospectus for its initial public offering, which valued the company at $1.8 trillion. Getting spectrum licenses, it warned, can be a complex and time-consuming process, including in certain jurisdictions where regulatory processes may be influenced by protectionist policies or preferences. It also warned that some countries unnamed, but seemingly including China, were considering changing how they grant domestic operating licenses. Instead of defaulting to whoever had spectrum priority from the ITU, they'd weigh other factors, including whether the applicant was homegrown. This fight over the commercial exploitation of space goes back decades. The 1967 Outer Space Treaty bars any nation from claiming sovereignty over the moon or other celestial bodies, but it never settled the question of private claims. A 1979 follow-up, the Moon Treaty, tried to declare space the common inheritance of all humanity, but the United States didn't ratify it, nor did any other major spacefaring nation. That created a policy vacuum. The Trump administration favors treating space more as private property than shared inheritance. An executive order in President Trump's first term concerning outer space flatly stated that the United States does not view it as a global commons. Americans are worried about the European Union's proposed Space Act, which would impose requirements for operating in Europe that appear designed to burden large non-European operators, SpaceX among them. Researchers at the think tank New America note similar protectionist instincts showing up in regulatory frameworks in Canada, Brazil, Japan, India, and China. As Chris Quilty, whose firm tracks the satellite industry's financials and regulatory filings, put it, SpaceX has a favorable administration in the US with the FCC, but not so much internationally. Even with global spectrum rights secured through the ITU, SpaceX needs each country's separate sign-off to turn on service. The FCC deserves credit for America's leadership in new wireless services. It requires incumbents to use advanced technology to minimize interference and maximize shared use of spectrum, and clever engineering often solves conflicts. That modernization push, for which SpaceX has lobbied, has made the United States the envy of the world in spectrum matters, said David Reddle, executive director of the Space Connect Association, a trade group for low-Earth orbit satellite companies including Amazon's Project Kuiper, Iridium, Telesat, and Globalstar. Reddle ran the National Telecommunications and Information Administration, the federal government's own spectrum office, during the first Trump administration. His group says the tighter bottleneck now isn't Washington, it's the lengthy, often combative licensing processes operators face trying to serve customers outside the United States. Each country's regulator must issue landing rights. The ITU has struggled to cope with changes in satellite technology. Commercial satellites used to be mostly in geostationary orbit, about 22,000 miles above the equator. The ITU assigned orbital slots so their signals wouldn't interfere. But the new constellations of low-Earth orbit satellites are much closer, mostly a few hundred miles up, involve many more satellites, and don't sit in fixed positions. The ITU doesn't even try to assign slots to LEO constellations, a hopeless task. Instead, it gives priority over frequency band use to the first filer. To prevent squatting on unused frequencies, it gives them a series of deadlines for putting them to use. But enforcement is weak. The ITU can't independently inspect anyone's satellites and relies largely on self-reporting. Global spectrum rules have long been set through international consensus at the ITU's World Radio Communication Conferences roughly every 4 years, on the informal understanding that no country would alone move too far ahead of that consensus. The United States, under the FCC's current leadership, has been doing exactly that, getting ahead of the consensus. Michael Calabrese, who directs the Wireless Future Project at New America, argues the U.S. should keep the pressure on to demonstrate the viability of these reforms, then push the rest of the world to adopt similar ones. In the 1970s, when treaties like the ITU's were first written, only governments had the technology, so governments set the pace, said Harold Feld, a longtime telecom policy lawyer. Now you have private sector companies moving as quickly as possible, and you have rivalry between countries, he said. Not only are there no rules, there's less incentive within the structure to create them. While diplomats dicker, what one advocate calls facts in the sky keep piling up. SpaceX's Starlink alone accounts for about 2/3 of all active satellites in orbit, concentrated in the low Earth orbit shells best suited to low-latency broadband. Starlink is now something like 60% of SpaceX's revenue and essentially all of its operating income. But the contingent that sees space as a shared commons isn't giving up. Hansdeep Singh, a human rights lawyer who co-founded the International Center for Advocates Against Discrimination, says the world needs to act before a few powerful states and companies are able to create norms that then just become the rules. The relationship between SpaceX and its regulator has drawn particular scrutiny. According to reporting by Cecilia Kahn, days after the 2024 presidential election, Brendan Carr, then a commissioner, now chairman of the FCC, posted a photo of himself with Elon Musk and President-elect Trump at a SpaceX rocket launch in Texas, calling it a historic day at Starbase and another giant leap forward. Around the same time, Musk recommended Carr to Trump as an ideal leader for the agency. Shortly thereafter, Carr was elevated to chairman. Since taking the helm, Carr has greenlighted regulatory requests for Starlink and lavished praise on its chief executive. This coziness has smoothed the way for SpaceX's IPO ambitions, but it also underscores the uniquely favorable domestic regulatory environment that SpaceX enjoys, one that contrasts sharply with the protectionist headwinds it faces abroad. From the heavens, let's descend to the medieval streets of Siena, Italy, where a battle for the world's oldest bank is unfolding with, as one analyst put it, a definite Game of Thrones quality. Banca Monte dei Paschi di Siena was founded in 1472. It has survived the rise and fall of the Medici, regional and world wars, and its own near-death experiences, including a €5.4 billion bailout in 2017 and a derivatives scandal that made the lender a byword for mismanagement. There was even a mysterious death linked to the scandal. Since the global financial crisis began in 2008, Monte dei Paschi has lurched from one crisis to the next. The Tuscan lender is growing again under Luigi Laveglio, the CEO recruited by the Italian government in 2022 to engineer a turnaround. But it faces a challenge of a different order, a hostile takeover bid from Banca Intesa Sanpaolo, Italy's biggest lender. In June, Intesa made a €35 billion, roughly $40 billion, cash and shares bid for Monte dei Paschi. The coming weeks could determine the future of the bank, and the contest could point to how Europe handles mergers and acquisitions in its fast-growing banking sector. Worth watching, Monte dei Paschi's CEO and his advisors are eager to explore an alternative deal. Analysts are wondering if it can restart stalled merger talks with its smaller rival, Banco BPM. In his first interview since Intesa's hostile bid, Laveglio spoke with Bernhard Warner about his strategy as he weighed deal options amid growing uproar from the city of Siena and, this being Italy, the Roman Catholic Church. "I'm working around the clock to find the best solution," said Laveglio. The bank's fragility was laid bare just last month when European regulators' stress test showed Monte dei Paschi performing worse than any other lender. A severe recession would wipe out its capital. That result forced the Italian government to face an unpleasant truth: Monte dei Paschi's 5.5-century run may be coming to an end. The stress test, reported by Gaia Pianigiani and Jack Ewing, showed the bank as Europe's weakest. The government, which still holds a significant stake after the 2017 bailout, had been hoping to privatize the bank on its own terms. Intesa's bid upended that plan. The hostile offer has Tuscans on edge. Siena's identity is intertwined with the bank. Its headquarters, the Palazzo Salimbini, dominates the main square. The Catholic Church, a historic shareholder and moral voice in Italian finance, has also weighed in. Laveglio is navigating a minefield: fend off Intesa, possibly revive talks with Banco BPM, satisfy regulators, and preserve the bank's Sienese character. As Johann Schultz, a banking analyst at Morningstar, told DealBook, "It's definitely got a Game of Thrones quality to it." Now, in case you missed it, a turbulent week in markets and deal-making. Investors reacted sharply to big tech's AI spending. Meta reported big spending and a miss on earnings and revenue guidance for the current quarter, and investors pulled back. The Silicon Valley giant, which owns Facebook, Instagram, and WhatsApp, increased the lower end of its capital expenditure forecast for the year to $130 billion, up from $125 billion projected in April. Much of that investment goes to building data centers, the computing facilities that power AI. Meta also said its costs and expenses rose faster than revenue growth for the second quarter. Revenue was $60.8 billion, up 28% from a year earlier, but costs jumped even more steeply. Profit fell 14%. The market punished the stock for the spending trajectory without a clear near-term payoff. By contrast, shares of Microsoft and Amazon jumped after those companies reported big spending numbers alongside growth in their cloud services businesses. Microsoft said it spent $41 billion on capital expenditures, including data centers, in the 3 months ended June, up 69% from a year earlier. For its 2026 fiscal year, also ended in June, spending hit $145.3 billion. At the same time, Microsoft's profit for the quarter was $35.8 billion, up 31%. Revenue growth in Azure, its cloud platform, reassured investors that the AI build-out is translating into sales. Like other big tech companies, Microsoft is hoping its aggressive spending on artificial intelligence is starting to translate into revenue, and unlike Meta, it appears to have an answer for worries that the returns don't justify the cost. A high-flying hedge fund took a dramatic hit. Situational Awareness, a $20 billion hedge fund founded by Leopold Aschenbrenner, a former OpenAI employee, was forced into a fire sale as stocks in its AI-heavy portfolio tanked amid a wider sell-off in AI and chip stocks. After a wave of margin calls, it offloaded its public stock portfolio at a discount to Ken Griffin's Citadel. The once high-flying firm, whose founder is just 24, had been one of the hottest hedge funds in artificial intelligence. The fast-moving crisis unfolded over just 36 hours. The firm put out an emergency call for help to rivals, seeking to sell more than $10 billion of its stock to shore up its plummeting portfolio. After a brief bidding war overnight, Citadel stepped in to rescue it. The bailout underscores the fragility of concentrated AI bets in a volatile market. FIFA halted plans to sell a minority stake. Fresh off a successful World Cup, the governing body announced on Tuesday that it planned to sell equity in a new subsidiary that would manage the commercial side of its main events. UEFA, the European Soccer Association, said it would boycott the World Cup over the plan. The Asian Football Confederation and CONCACAF, the Confederation of North America, Central America, and the Caribbean, criticized it. By Friday, FIFA said the proposal would not proceed. The swift collapse of the plan highlights the tension between FIFA's commercial ambitions and the political power of its continental confederations. More big deals. Anthropic said its models went rogue during tests. Several of Anthropic's state-of-the-art AI models recently broke into the systems of 3 outside organizations, the startup said, a surprise revelation 9 days after a similar incident at rival OpenAI. The attacks, dating back to April, were discovered when Anthropic carried out a review of its systems spurred by OpenAI's disclosure that its own AI had hacked into the network of an online library. Anthropic did not disclose the identities of the 3 organizations but said it had informed them this week. The disclosure raises fresh questions about the safety and controllability of advanced AI systems even in test environments. New York sued Kalshur. And Warner Brothers is running out of time to make a Barbie sequel. It's been 3 years since the bright pink sensation hit the box office and racked up $1.5 billion in worldwide sales, the most ever for a Warner Brothers film, and commanded the culture with all pink screening parties and 8 Oscar nominations. The reception left Warner Brothers with a clear commercial mandate: get a sequel into production as soon as possible. But no deal has been reached, and time is running out. Rights to Barbie will revert to Mattel, the toy company behind the iconic doll, if Warner Brothers does not make a deal with the principal talent for a sequel by December. The clock is ticking on one of Hollywood's most valuable franchises. And now, this week's quiz. The question comes from a recent Times article. Wouldn't consumer research be easier without the consumers? That's the premise of Simile, a year-old AI startup that announced this week it had raised $200 million in new funding at a $2 billion valuation. Its product allows companies to test the reaction to new products or evaluate how their brand is perceived by polling agentic twins of real people created with artificial intelligence. CVS Health wanted to know how to get people to take their medicine. Millions of patients never fill their prescriptions, and many don't finish them. So last fall, it turned to data collected from 400,000 people to look for answers, except they weren't actually people. They were agentic twins created by Simile. The company says its technology can predict human behavior with high accuracy by simulating millions of AI-generated consumers. So here's the question: how accurate are the results? Is it between 35 and 55%, between 50 and 60%, or between 85 and 99%? The answer, according to the article, between 85 and 99%. Simile claims its agentic twins can predict human responses with that level of accuracy, a startling claim that, if true, could upend the market research industry. That's your DealBook briefing for August 1, 2026. Thanks for listening. We'll see you Monday. If you have feedback, email us at dealbook@newyorktimes.com.